Should the small and mighty real estate investor, should the one rental at a time fan just give up and copy Invitation Homes? Is Invitation Homes showing us the secret to building wealth? Let's have this conversation with Coach Carson, man. How you doing, Coach?
Doing well, Michael. Thanks for having me.
Absolutely, man. You came prepared today. You're bringing the heat. You actually went ahead and read the annual report, and you've kind of pulled out some nuggets that we can riff on. And should we copy? Should we just give up and do what they're doing? So let's go.
Yeah, I want to share some stats with you, but I want to tell you why other than I'm just a nerd and I like to sit there and think for 2 or 3 hours anyway. But I've been having conversations with people in my community on my YouTube channel, and it sort of has broken down to there's people who have a lot of time and not much money, and there's people who have a lot of money and not much time. And I'm thinking about those second people, the people who are, an engineer, a doctor, a full-time, whatever you're doing, you've got a little bit of time, you get more money. And I've been trying to push people to invest in higher quality properties and higher quality locations, basically more of a buy and hold growth, kind of a hybrid between cash flow and growth, but more on the growth side. I've been pushing people that way. And I've gotten a little pushback from some people that, I don't know, I should be doing the BRRRR strategy. I should be doing these, fixing up stuff, buying cash flow properties. And so it just led me to want to do some research saying, you know what, let me look at the top, the single family house owner who owns the most single family houses in the US. It's a REIT named Invitation Homes. They own 85,000 homes as of last year. And what was really interesting to me, I wanted to actually look at the buy box of Invitation Homes. We talk about buy boxes all the time, right? So if we're going to share the buy box, and I'll just share a few stats that I found interesting looking at their annual report. The first thing is they average, I think, about $350,000 for the price of an average house.
Okay.
The average house has a rent of $2,300. So this is nowhere close to the 1% rule, right? 2,300 rent, $350,000, 1,880 square feet, 3-bedroom, 2-bath. I assume those have garages, although that's just kind of a typical house. They're looking for a renter, and let me read you the kind of the MO, like at the top of their annual report. It says we focus on high growth markets and infill neighborhoods with proximity to jobs, transportation, and schools. So I think those are the two key components there. We could break down what those mean, but high growth markets where the population is increasing, where jobs are increasing. That's like the number one metric. And that's what I look at a lot when I'm looking at markets to invest in. And then the other key that I also love is infill neighborhoods. So you're looking for places that have density where there's already a lot of houses built, and it's difficult to build more houses in these infill neighborhoods. You have a few houses here and there. There's an extra lot here and there, but there's not like thousands of homes coming on the market in this little zip code because it's mostly built out. There's just a lot of density. So you take those like the specific buy box of that type of house. That type of house attracts a tenant who's like moving up from apartments. They don't want to live in an apartment with somebody else. They want to stay there for a while. They want to have longer, tenant retention time. They want to be close to jobs, close to income. Their average person makes pretty good money. They're 6-figure kind of earners. And so you put all that together, and this is a equivalent for a small and mighty investor. This is like my mentor, John Schaub, who started buying in Sarasota, Florida. He buys the exact same house. If I ask John Schaub what he buys, 1,500 to 1,800 square foot, 3-bedroom, 2-bath house with a 2-car garage with a lot of storage. So they stuff all their stuff in there. His tenants stay for 5, 10, 20 years at a time. And it's just a boring quality house, nothing sexy, but you try to get a good quality house and you try to get it at a good price, and then you hold on to it. That's what I see.
I think it's magical. And I've been doing this a long time. And I actually remember when I call it Wall Street, right? When Wall Street came in and changed single family markets forever, and Invitation Homes was born, frankly. I think it's really interesting to realize that Invitation Homes buy box has changed. So, and if you don't know what I mean by that, is back in like 2010, 2011, when they changed my world, right? They came in, they bought the entire tape. What is it, tape? The tape is what they refer to as a list of foreclosures. And they came in and bought the entire tape and paid list price. And if you know my story, I was routinely buying stuff for 11 or 12% below asking because that's where they would say yes. It's like, you just figure it out. And Invitation Homes has gone through some growing pains because when you're buying a tape, you're getting stuff all over the place. You're not getting economies of scale. The other thing that Invitation Homes is written about is the homes that they were buying were older.
Mm.
And I think, Willie, I think what you're seeing Invitation Homes do is uh, they're also averaging younger or newer homes.
Yes,
Invitation
building new
build.
homes too. Yes.
Yes, that's where I was going is I really think the future for a lot of these folks is going to be selling off homes that are 20 years or more older and moving that money into build for rent. They're going to buy entire communities.
Mm-hmm.
And to them that just makes more sense, right? It's kind of a apartment, if you will. It's just spread out over a lot of dirt, and it has amenities like parks and things of that nature. So I I think I think Wall Street, again, REITs, single family REITs like Invitation Homes, is clearly articulating it's hard to scale buying onesie twosie all over the place. It's costly, and they're going more concentrated. Like if you look at Atlanta, Atlanta has some of the most high concentration of single family REITs or build for rent because they're doing 100-unit communities, 200-unit communities. So um, I think it's an attractive buy box. I mean, I've been very clear with folks that if I were to transition my portfolio, I would sell the old stuff and buy newer as well. I don't think
Mm-hmm.
I'd buy brand new because but I'd buy something 10 years or less for sure. So it's an attractive buy box for sure.
Yeah, and I think you do. The key points I heard from you there, you have to evolve. Like you have to evolve
Mhm.
your buy box. But I think the thing that there's two things that they have figured out, and I'm sure they figured out the same things we've all figured out, is that when you buy those old properties, it's really difficult to estimate capital expenses and what that'll do to
Exactly.
your cash flow. So
Right.
the old properties I own. Well, here's the mistake a lot of us make, we and myself included. You buy this property, and you're like, oh, well, somebody can move into it. It's rent ready, quote, rent ready. Somebody can move into it. Well, you know what? That roof that has 5 more years left on it, the heating and air that has 2 more years left on it, the plumbing that is 50 years old, like all of that stuff costs like many thousands of dollars. And just one of those goes out in the next 2 to 3 years, and 100% of your cash flow is gone.
Gone.
And so
Exactly.
like so that is underestimated. Like every time I analyze deals with other investors, they're almost always underestimating maintenance costs, almost always. And
Mhm.
it's really difficult to compare apples to apples. And the one, I'm a fan of the small and mighty investor. We all know this, but the benefit that an Invitation Homes has is that when you have 80,000 properties and you've analyzed thousands and thousands more, you can look at the metrics and see which properties are doing better than others. And you can kind of call off and sell off the
Mhm.
ones that are not doing it well, and you can double down on what's doing well. And I've tried to do the same thing actually. So we can do the same strategy. I see that more as like a harvester strategy. Later in your career, you've grown, you've built up, then you need to look at your portfolio and have good bookkeeping so you can actually see what properties are doing well. And then you sell off the losers and you keep the winners, and you
Mhm.
improve your portfolio over time. And that's really what they've done. And so if we're I think the message for me as a small investor, I think we have a competitive advantage against them because they have to go to markets where there's a lot of scale to be able to really kind of buy enough properties. I tell
Correct.
people I like to go to the big markets like Atlanta, Charlotte, same markets they're looking at, but then I go to those little satellite cities, the little 20,000, 10,000, 15,000 person towns. They're like the moon going around Saturn or the moon going around
Right.
Earth instead of trying to buy Earth. And then you buy those little towns that are in the gravity of the big economy. So they have jobs, they have income, but they're in these little markets where maybe you could, Invitation can only get 1 or 2 properties there. Why would they mess with it? But for
Right.
you need 3 or 4 properties, then that could be a great market, and you could make a killing, and you could be a big fish or a small fish in a tiny pond, whereas the
Yeah.
big whale is not going to go in that tiny little pond.
Yeah. I mean, the biggest thing that I've learned competing with, I call them hedge funds or Wall Street, just kind of a blanket statement, which I've had to compete with over the years, right? They came into the Central Valley in a big way when the market fell 75%. I always try to find their buy box and then I stay out of the way,
Mm-hmm.
right? Like for example, one of my greatest profits last time was understanding that they were only buying 3 and 4 bedrooms. They wouldn't buy fives and they wouldn't buy twos. Again, they have a lot of money, but they're not hands on.
Yeah.
So what did I do? I ended up going after every 2 bedroom that was I think over 950 square feet because I wanted to get in those, and a fair amount of them could be converted to 3 bedrooms for 2 grand, $2,500, a wall, a door, and a closet. And the beauty of that is I could buy a 2 with no competition. I could create a 3, get a lot more rent, and if I ever wanted to sell it, they could become a buyer, right? Because now it's a 3. So sometimes it's really cool to know where the whale is, because you can pick off the stuff that they're not looking at. And if you could pick off the stuff they're not looking at and create something they're looking at, they'll overpay. I remember iBuyers. iBuyers came out, and I told this story years ago. I knew people in Phoenix who were locking up properties and laughing at what iBuyers were offering to them, because they just figured out what the iBuyer wanted. They figured out kind of the algorithm, and they were laughing. They're like, I can't believe that they paid, 40 grand more than required. Their algorithms are screwed up. Let's keep feeding them as much as we can. And that's how they lost, almost $1 billion, because they freaking overpaid and they relied on their algorithm. It was literally laughing their ass off every time they sold one to one of these iBuyers. It was pretty funny.
Yeah, I think my lesson there too is that we small and mighty investors can stare at our spreadsheets too often as well. Like it's look at the numbers, yes, but to me, the biggest mistakes I've made in real estate is not balancing like those qualitative, in the market, boots on the ground, gut feel kind of decisions with those quantitative decisions. Like if you just, this is Warren Buffett's always said the same thing. Like he kind of laughs at these quants who always come out of Wall Street, who always have the next thing figured out. And we've figured out how to analyze the risk and quantify it. We've got it in a big spreadsheet.
We've removed the risk. That always gets Buffett laughing.
Yeah, here we go. And so he's like, okay, watch this, and he buys something the opposite of what they're buying. So we have to combine the two. And I think the benefit for being a small investor is that we can be boots on the ground. We can use conversations with people to influence our decisions. We can do the little, just because their robot says 3 bedrooms, we can say, well, this was 1,200 square feet and it's 2 bedrooms. We can turn that extra room into a bedroom. Like those are the kind of like entrepreneurial moves, the pivots that you constantly make, but there's still core principles underneath that, which is there's certain things that tenants want. There's certain maintenance profiles that we want to follow so that we can reduce our maintenance. Newer properties tend to be lower maintenance than older properties. Buying in dense areas that are infill instead of trying to always be on the edge of town. Like I think that's really important. Being near transportation centers for me has been really important, whether that's suburbia, being near interstate, or in a town. I like to buy near walking trails, biking trails, sidewalks, walkability. So like those ingredients, like the ingredients of the soup that make a good investment are pretty similar. There's some varieties, but the core principles are something that we have to study and then build your own buy box based on all that.
Yeah. The other thing you brought up earlier, I just want to go back with you. You talked about first investors, kind of not understanding capital expenses when they buy older homes. I also want to go back to your point about turnover. Your turnover will just be less over time in a 3-bedroom, 2-bath, 2-car garage home in a decent area that's growing with good schools. It just is. Now, you may be unlucky and have a couple of turnovers, but when you look at scale, those homes will have less turnover. And I have people in homes like that for more than a decade now, and probably going to be there another decade because it's their home. That's what they look at it as. And yeah, if you're going to be a small and mighty investor, and go back to how you open this, right? You don't have a lot of time, but you have some seed capital. Invitation homes, might be a good strategy for the small and mighty investor. You're going to probably have to put a little bit more down because I don't want you to have an alligator property. But again, if you're looking for slow and steady wins the race, seems reasonable to me.
Agree. And one final point I'll make about that quality kind of property. You mentioned the turnover, like a turnover, also higher tenant quality. Something it's hard to rate that, but when you have a better property in a better location that's in demand, then I have some of my best properties. I have 5-10 tenants apply for that one place, and I get to pick the best tenant who's most qualified. Right. As some of my worst located properties, there's like, please, you're jumping up and down with a sign on the corner, like rent my house, please. And you might get a certain rent, or maybe you have like I've had some weird properties with 3 units on the same property, but one's like a garage converted apartment, and it's just not a desirable way to live compared to just a single family house with a yard and all that. So the same amount of income from the less desirable property with that quality single family house, you can pick the best tenant who is going to likely pay you on time. You can pick somebody who's likely to stay longer. So there's just the quality of your portfolio, the quality of your balance sheet is something I've learned over time is not always the same based on the maintenance of the properties, based on the quality of your tenants, based on how long they stay, but your buy box influences all of that stuff. And so you have to choose really carefully.
Yeah, and it's something else you brought up that kind of just want people to realize, if you're like at least myself, you're going in and you were buying, older stuff. I definitely think you need to kind of prune the portfolio. It's something I've done the last 3 years that we've taken the worst performing asset and gotten rid of it, either a 1031 or just took the cash and paid taxes. But you can also 1031. I think there's certainly some value in getting great deals. And if you start with cheaper stuff, as you mature and your portfolio grows and you go from one season of life to another, 1031ing into another, newer, higher end units, it's not a horrible strategy. And in fact, is one that Olivia and I will likely be doing.
Yeah, we've done that too. We started off with the old stuff, so let's not criticize what we actually did.
So we did that too.
I started with the old stuff. But here's the thing: I got them really cheap. So when you do the 1031 exchange, I had a ton of equity in that. So like you need to buy the old properties and the cheap properties even cheaper than you think, because that's what a good deal means. Whereas on the quality properties, you're probably not going to get those at 50 cents on the dollar, 60 cents on the dollar. 10 to 20% off would be a pretty good deal in a quality location. So it's just a different, that's one of the things I'm trying to coach people on is first understanding your situation. Are you somebody with a ton of time or a ton of money or a combination of that? And if you are the less time, a bunch of money, then think more about the long-term strategy, being the patient investor, buy these quality properties, put more money down, and then play the waiting game that a lot of like entrepreneurs who don't have a lot of credit and cash can't play that game. But whereas so there's a strength and a weakness for every investor. You just got to know how to play that and pick the right property that kind of matches your particular situation.
Folks, please, in the comments below, let us know. Are you going to copy Invitation Homes model? It'd be very interesting to see what you think. Again, there's a lot of things they are doing right. They've obviously pivoted and learned from what they started doing to what they're doing now. I think it's pretty clear where they're going. Coach, Small and Mighty Investors, how can they follow you?
I'm on YouTube. I have a podcast every single Monday that comes out. So check that out. Leave comments on my videos. I'd love to hear from you. And you can also go to my website, coachcarson.com, and have a lot of articles and old archive of everything I do over there as well.
Thank you so much.